This is the summary of all of the data, and you'll see it's a good equity curve. There's a little bit of volatility in it, but not much. The starting capital was at $23,000. Currently, we're at $40,224, about a 75% return so far in about 10 and a half months. And the key statistics, of course, is the total return. And then down here, you'll see the average winning trade to losing trade, which is a little over 2 to 1. And the max drawdown has been 6.99%. I can show you exactly where that was. That was right here, but it was a very quick recovery. Came down quickly, went right back up. The previous drawdown to that was 5.25%, which was right here. And again, that was also a quick recovery. Before that, the largest drawdown was 3.25% way back here. Now, the reason why we had these larger drawdowns in this area was that as of this point right here, I think it was trade number 220 or so, I switched from a single position to two positions, or double-sized my minimum position size, because that was my plan all along. I'd said that when I get to about $35,000, I would do that. And so once switching to that, the volatility, as you can see, sort of went up and down and got larger, but also not only were the losses bigger, but the wins were much bigger too. And so overall, I think that once this goes on and you're out around 1,000 trades or so, you'll never even see this. It'll look like a straight line. So speaking of the number of trades, this represents 287 trades since we started this particular account. And here's another very interesting stat. The average risk to reward is 9.6. That means for every dollar that I put at risk, we're looking at a potential of almost $10 of reward. So that's pretty telling about our strategy. And I guess one other thing that should be noted here is the percent profitable. If you look at that, you'll see that it's just under 45%. So this is not a high win rate strategy, but it doesn't have to be. That's because the risk that we take is so small that it's almost not worth even managing. So instead of managing our risk, we make a defined risk and then manage our profits. So we're spending really the vast majority of our mental capital on managing profits. So there you go. There's the highlights. I think one thing that you should note is that we have this tenet that we say capital preservation first, profit second. So everything that we do is predicated around our process and our framework that we invoke, and it's a continuous improvement process. And we're focused on keeping everything in that process consistent. And that's what gives us our long-term, really incredible returns. I mean, it looks like I may, in the next month and a half, if I keep up with this performance, may hit 100% return in a year. Now, I know there are others out there that have achieved much more or whatever, but this is consistency. The very first year in the four-figure account, I actually tripled the size of that account. And that's a little bit easier when you have a smaller account. When you start going to a larger account, like in the mid-20s or whatever, at first I had to deal with the pattern day trader rule, so I had to take things a little easier. Once I got beyond that, I could open up a bit. And when we get to the six-figure account, you'll find that the growth perhaps won't be quite as dramatic. Instead of maybe going for 100%, we'll be going for anywhere from 30 to 50%. And that, in anybody's book, would be a fantastic return.